Hello, I'm David Chester with 90 at 9, brought to you by interest.co.nz. This week at everything you need to know in 90 seconds at 9 o'clock, with news markets are increasingly worried about the state of the Chinese economy, a place where Beijing is trying to keep bad news from leaking out. But first, American producer prices surged higher at the rate of 2.9% and well above expectations. This was the highest rate since September 2012, and markets expect that to bolster the Fed's resolve to raise interest rates again next month. And US wholesale sales for September were revealed to be nearly 8% higher than the same month a year ago. And inventory rise is part of the reason, up more than 5%. Mexican industrial production rose impressively in September, although at about the rate analysts were expecting. NAFTA is still working well for them, bolstered by American companies ignoring Washington's bluster. In China, consumer prices rose 2.5% in October and at the same rate as September, while the growth in producer prices fell to a 7-month low of 3.3%. The Chinese premier called for lower interest rates on loans to private sector companies. This follows another top Chinese official who called for stepping up credit support for the private sector as China's economic expansion slowed to its weakest pace since the 2008 GFC. Although the private sector accounts for more than 60% of their economy, it receives only 25% of Chinese business loans. However, markets are worried by the push, downgrading bank stocks. One firm who doesn't need loan support is Chinese e-commerce giant Alibaba, who did a record $45 billion in sales yesterday during its 24-hour online retail frenzy Singles Day, smashing the previous record. That was more than 27% more than last year, but oddly this is their lowest percentage year-on-year growth ever in the event. The dollar growth, of course, was still a record. But Chinese new car sales are on track to decline this year for the first time since 1990, in a further indication of a slowing economy there. Still, the iron ore price is rising and rising on Chinese demand. Wall Street was down more than 1.3% on Friday. Shanghai was down 1.4% on those Beijing-mandated calls for banks to lend more than ever to risky clients and at reduced interest rates. Chinese financial system resilience and stability may face some self-imposed challenges. And back in the US, the Fed will start following many other central banks later this month, releasing a semi-annual review of American financial stability. And the US Treasury 10-year yield is now at 3.19%, a dip of 2 basis points over the past week. Their 2-10 curve is lower at 26 basis points. The Aussie government 10-year is at 2.75%, the Chinese government 10-year is at 3.50%, while the New Zealand government 10-year is at 2.82%, and that was up a remarkable 21 basis points over the past week. New Zealand swap rates rose 15 to 25 basis points across most durations. Gold is down sharply at $1,209 a week. That's a $24 drop for the week. US oil prices just keep on dropping and today are just over $60 a barrel. That is a $3 a week change down. The Brent benchmark is now $70, also a pullback from this time last week. Those cumulative declines put oil in a bear market. Excess supply is the core reason, from everywhere from Russia and Saudi and to diverted Iranian supply. Now, Saudi Arabia has suddenly decided to cut production by 500,000 barrels per day. The Kiwi dollar ended last week 1 cent stronger at 67.4 US cents after the good unemployment data and higher inflation expectations. On the cross rates, we're also firmer at 93.3 Aussie cents and stronger at 59.5 euro cents. That puts the TWI back up to 72 and it's starting this week near its highest in 4 months. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.